Hello, my name is Tyrena Jones, and I'm a certified public accountant and a top 100 QuickBooks Pro advisor with over 30 years of experience in helping businesses manage their finances. Today, I'm going to talk about how to read a financial statement and why should we learn how to read a financial statement. Let's start with that. So one of the reasons that we keep records and books is not just for tax compliance, although that can be a large incentive and motivator, but one of the biggest reasons we keep ongoing records, contemporaneous, we would say, is that we want to measure the health of the business. So the measurement of the health of the business is in a few different areas. And there are three main financial statements, and you may or may not be familiar with them. Two of them are at the top of the favorites at the screen. And I want to go over each one of those and explain how to read it and why it's important for your business. So the first item I'm clicking on is a balance sheet. So a balance sheet, let's look at the components. So at the top, we always have listed the name of the entity, and so this is for Craig's Design and Landscaping Services. This is not for Craig's personal accounts. This is not for Craig's other business. This is just for Craig's Design and Landscaping Services. So that's number one. So when your books are set up and you're running a balance sheet, we're just looking at the performance on this one entity, right? Okay, so we have the title of the report, balance sheet, and then we have the date. And one of the things I want you to note is that the date on a balance sheet always says as of, right? It's not a range. We get to the profit and loss in a moment. It's always an as of date, and that's because we're looking at a snapshot of what your financial picture is at a date in time, right? So that tells me. So let's go into the components. The first major section of a balance sheet is the assets, right? So we have assets and we different kinds of assets, and we have our total down here. So assets are what exists on the date that we have run the report. So this is what our checking account and our savings account are as of, if we ran this October 6th, and this would include any uncleared checks the bank doesn't have yet. So this is what our books show that we own in our bank account on October 6th. This accounts receivable shows what our customers owe us as of today, October 6th, right? Inventory 596, that's what we have as an inventory out in our warehouse. And then we have undeposited funds, which means that should be money that you've recorded, right? A check maybe from your customer that you've recorded that you haven't put in the bank yet. So these are all assets. These are things that you own. So think about an assets, things you own, right? And then the next section, we have truck. We have a truck, original cost, $13,495. We always record assets, most generally, at the original cost of the asset. So if the truck is worth, you paid $13,495 and you paid $5,000 cash and you got a loan on the rest, we still record the truck at original cost. So when you look at a balance sheet, all of the assets should make a lot of sense to you. You should be able to look at a balance sheet, even if you don't know a lick of accounting, and you should be able to say, do I truly have $2,000 after all the checks, if all the checks I wrote have cleared? Yeah, that makes sense. Or do people really owe me $5,200? Does that make sense? You have to give it the reality check, right? Or inventory, that doesn't make any sense. I got 59,000 out in the warehouse. Then that leads you to problems in your financials, and a lot of people just like to look at the profit and loss, but I think that the balance sheet is absolutely the most important report that I always start with, because when you don't know how to read a balance sheet, problems can hide here. Problems in your bank account can show on the balance sheet. Problems in how assets are recorded show on the balance sheet. How well you collect money from your customers, particularly when we look at the balance sheet over a period of time compared to a previous time. So if I were to look at this compared to a previous year, I could say, oh, your AR is going up. Maybe your collections, either your collections are getting worse or you're earning more money. could be either one. So these are your assets, right? And today I'm not going to go into these different categories, but generally in accounting we have different types of assets. So we have current assets, and those are things that can be basically converted to cash in a year or less, right? So we consider checking and savings, accounts receivable, and inventory and undeposited funds all as a current asset, which means that if I had to liquidate that all very quickly, I could liquidate that and get that for cash. Fixed assets are in their own category, and then we have something called other assets, which you do not see on the screen. But generally, the asset section, think about it in terms of this is what I own. Now let's go down to liabilities. I'm going to shrink this up. Okay, so the second section on a balance sheet is the liabilities and equity. So think about this. For all of these assets that you purchased came from somewhere, right? So you either got a loan to pay for those assets, you have a debt in accounts payable, say you bought a tractor or something, you have a debt on accounts payable, a MasterCard. Somehow we had to pay for all these assets, right? Or money's in the bank. So you either had a note, or you used your credit card, or you had prior earnings, right? So retained earnings is your prior earnings from prior periods, or the owner puts money into the company. So think about this is the liabilities are what you owe to other people, right? And the equity is what is left over after you have assets minus your liability. If you were to liquidate the company today, you would be short by $7,600, right? So that's how you read that equity number. So that's an important number to know. So think about this in terms of your house, right? So it's really easy to understand. If I were looking at a balance sheet for my personal residence, my house would be an asset, right? And then my mortgage would be a liability, and the difference would be my equity in the house. Now, we're not talking market value. Let's just say purely what you paid for it minus what you still owe on it. And so this number down here is a quick snapshot of, are you upside down or not? Are you upside down in your company? And what I mean by that is that the creditors own more of this company than the ownership does. So that's one way to look at a balance sheet, right? And the reason we call it a balance sheet is because we have assets, right, up here, and we have total liabilities and equity down here, and the two must match. So it's like I said, you have your assets, and this tells you basically how were those assets paid for, how were those assets acquired. Some were acquired with net income, some were acquired with a note, and some may have been acquired with a loan from family or friends or anything like that, or simply by debt to accounts payable. So your balance sheet should always balance. So the balance sheet tells you really where you're at in terms of how much you owe and how much you own. And it's a really important number to look at is what is this equity number down here? Because this is where you will start to feel cash crunch. This is where you can look and see your performance at a certain point in time. So that's why I believe that the balance sheet is actually one of the most important tools and reports that you should look at. Because if this isn't right, if your balance sheet is wrong in any way, none of your other reports will be right. Your profit and loss will be wrong. Your cash flow will be wrong. Your accounts receivable could be wrong. So I am heavily a proponent of making sure your balance sheet is right, and then we look at the other reports. So let's go to the other report. The next report that's really important to give you the health of your business is the profit and loss. So we're all a little bit more familiar with this. Business owners always want to see their P&Ls. So let's talk about the structure of this particular report. Again, this is the profit and loss for Craig's Design and Landscape Services only. This is not for any other side businesses, personal This is only for income and expenses of this entity. Very important. It's called a profit and loss, and we also call it an income statement or statement of income and expense. So there's a few different names. Now notice the date. Really important. A profit and loss is always over a range of time, right? We always want to see what's our profit and loss for year to date. What's our profit and loss for the month, right? So that's very different from the balance sheet. The balance sheet is a point in time. Profit and loss is a range of time. Typically, when you print them together, you print a profit and loss for a period of time, let's say January 1 through October 6th, you would print the balance sheet for whatever that ending date is so that they are comparable. You can't print a balance sheet as of one date and a profit and loss range as of a totally different date because they won't make any sense. So keep that in mind. If your P&L says October 6th here, your balance sheet needs to say October 6th. That's very critical. So running those reports, super important how you do that. So let's look at the components of a profit and loss. Income, right? So we have many different kinds of income. Usually this is all income from the business. If we have other forms of income, let's say a tax credit or a rebate or, an insurance refund, something like that. That's not the kind of income we want up here. We really want to see our income from our operations. How are we doing with our core product or service? So cost of goods sold is what it takes you to generate this income, right? So in the construction industry, for example, cost of goods sold might be your employees, your materials, and subcontractors, and maybe some other things. If we were in a retail company, our cost of goods sold would be the cost of the products we bought so we could sell them, right? If we were in a restaurant, our cost of goods sold might be food, would be labor, and maybe restaurant supplies. So cost of goods sold is what it takes you to produce that income. And that leaves you with your gross profit number. And your gross profit number, so let me back up a second. Your gross profit number helps you understand if you're comparable in the industry, right? So you can start to use industry benchmarks to understand if you are on track, right? So really important to segregate those things, particularly in construction. Okay. And then we have expenses. So these are your day-to-day expenses of running the business. Some of these are fixed expenses. Some of these are variable and overhead, right? So this is the QuickBooks Sample Company, which you can find online if you were to Google QuickBooks Sample Company. So Craig's Landscaping. Craig's Landscaping has put job materials down here in expenses. I would move it up to cost of goods sold because it's part of the cost of his main product or service, right? In this case, QuickBooks has put it here, so I can't change it in the sample company. But the other things, so for example, insurance, equipment rental, fuel, advertising, those are all general administrative expenses, utilities for the business, office expense, things like that. So you come down to the bottom, you get your total expenses, and we get total operating income. So total operating income is very important to know how you're performing over a period of time. So I always run this monthly, and then we always do what I like to call a trend report. So let me show you how to do a trend report. So I'm just going to display columns by months and run my report. I love this report in terms of a profit and loss because I can see if there are gaps or there are holes, if we're missing expenses, or if things are just miscoded. But this is where the profit and loss gives you a lot of detailed data to run your business better. And then you can start to do things like develop a budget and control costs. Everybody wants to control costs now, so we need to see. You can also find missing payments that way. So if you're having trouble with accounts payable, keeping things up. So we had rent in August. Why didn't we have it in September or October? And then you can start to ask questions because every financial statement tells a story. And so what does your story tell? Does your story tell that your finances are a little bit out of control and that you don't have a good system in place to analyze your finances? Because if your books aren't up to date and your QuickBooks isn't right, then that's the story that would tell is that you don't really know how you're performing, right? So it's important to make sure that one, everything's set up properly, and that two is that you understand how to read these reports. And because at the end of the year, if we run this report for the whole year, generally that final number for the whole year would be, what your business's profit was for the whole year and what you may pay tax on. So the profit and loss is also a really, really useful tool if you learn how to use it and have it set up properly. Everything starts, if you go back to my setup video, everything starts on how you set things up so that you can have a standardized profit and loss and a standardized balance sheet. And those are the two main financial reports. I'll do another video soon on how to read a cash flow statement, but if you can just get the basics on how to read the financial statements of the balance sheet and the profit and loss and understand them, you'll go a very long way in making your business more profitable, more organized, and more efficient.